Julius, it's my pleasure to welcome you to India.
Thank you very much.
I believe this is your first trip.
It is.
And I just hope this is the beginning of a long relationship with India, Indians, and the Indian market.
Looking forward to it.
See, your background has been in the Air Force.
That's right.
I believe. Just want to understand as to how you got hooked on to market technicals, and what sort of a common trail is there between what you're doing at the Defense Forces and when you developed the RRG?
We got 30 minutes, right?
Yeah, your timer is there.
It's, well, I mean, I studied at the military academy, and like with every study, you have to write a thesis at some time.
Right.
And this was 1986, 87 when I had to do that.
Mm-hmm.
And the Dutch Air Force was just buying new F-16 planes in the US.
Right.
And obviously we have to pay them in US dollars.
Mm-hmm.
At that time the euro didn't exist, so we were on Dutch guilders. And there is a law in the Netherlands that requires every governmental body, including the defense forces,
Right.
whenever they buy something in a foreign currency, they immediately have to purchase that currency.
Oh, you didn't have options.
Well, they were there, but the
Okay.
law said that, so we were buying, for like hundreds of millions of guilders worth of F-16 planes, and we were buying all these dollars right then, but at that time, the US dollar against the guilder was going down like a rock.
Right.
So we had all those millions of dollars in the bank, and we were just losing money on it. So I looked at that, and I was sort of, in my private time looking at, financial markets. Options were just getting to life on the European Option Exchange. So I wrote my thesis on how the Dutch Air Force could save a lot of money by just protecting that position in US dollars with options, or just not buying them at all and buy a call option so you get the rights to call it. So that was my entry in the financial markets. When I had that knowledge on options, I started working as an officer, and the EOE, the European Options Exchange, just got started, and I started teaching private investors on the ins and outs of options. What is a call option? What is a put option? How does it work? What is a spread, etc., etc. The firm that I did that for was using a lot of technical analysis. So I started, getting more interested in technical analysis, self-taught, etc., etc. And then I ended up landing, a job in the financial markets with a life insurance company. And that's when I left the Air Force.
Okay, and after that you developed this RRG.
Yeah. Your question was how it's related, how my
Yeah.
defense force was related to RRG.
Right.
Well, at the time it was not, but with hindsight, now that I can see, because we will be looking at some RRGs later on, but it looks like a radar screen, and my job in the Air Force was being a local air defense control officer. So I was basically looking at a radar screen, identifying friends and enemies, and allocating missiles to enemy planes, which looks like, so in hindsight it's probably related to that, but honestly I didn't think of it when I was developing RRGs.
Yeah, but surely that experience would have helped you in
maybe
developing
unconsciously,
this.
probably,
Now see, as technical analysts, we normally use momentum indicators like RSI to understand whether the stock or a specific sector is overbought or oversold. But it would be great to hear from you how different is RRG, which is relative rotational graphs. And also, just one more question following that. Is there any connection between the RSI indicators and your methodology?
No. It is relative rotation graphs, and you refer to the RSI, which is relative strength index. What RRG does, it uses relative strength, but relative strength between two securities. So a sector versus a benchmark.
Would you like to? Are you carrying any graphs which can show?
Yeah, I think we can. We can actually see if what we have here. I probably have to. We got a chart. I have to browse through a lot because I just put together a few.
Yeah,
so this is a relative strength chart. This is the chart of the. I believe it's the Nifty IT index. That's just the chart above. And then the line below is the relative strength line that shows the ratio between the IT sector and the Nifty index. So when that blue line goes up, IT is outperforming the broader market, and when the line goes down, it's underperforming. And that is very crucial for institutional investors, because these people usually don't have the ability to go to a lot of cash. You know, if you manage a big fund,
right?
You know, there's no way you can sell all your funds
You
and
can
go
hedge,
to cash.
but you
Yeah,
can't,
so it's
be
very
selling,
difficult.
yes.
So what these people need to do is find pockets of strength in the market, like sectors or individual stocks, that are outperforming their benchmark, because they're usually hired to outperform a benchmark.
So basically, if you're looking at, say, 200 stocks to find out as to which is outperforming and which is underperforming, and then to plot that, I think your program actually shows that in one sheet.
Because the problem is that when you do that, this chart here is a one-on-one relationship. So you can look at a sector versus the Nifty, and you can do that for, I think there's 16 sectors in India. So you basically look at 16 charts.
Right.
And you will find that IT is doing better, and banks are doing better, and maybe metals is doing better. But if you want to know, you know, between metals and banks, which one is better, you need to make the comparison between metals and banks. And let me see, because I do have a slide that shows that pretty neatly, actually. Because this is how people normally plot a lot of relative relationships, and I just call these spaghetti charts. I cannot read them. I cannot find any trends. It's just anchored to some point in the past. It doesn't tell me much. Let me see, where is my... Yeah, this is the one I'm looking at. The labels are for US sectors, but it's as easy for Indian markets. So this is the 10 US sectors. Well, if you put them together, it basically means that you have 100 different combinations that you need to look at for all possible combinations. Now, if you've looked at, you know, banks against banks, you don't have to look at, or IT against IT, you don't have to look at. So the diagonal, that can go. So this is a 10 security universe, so 10 by 10 is 100, minus the 10 in the universe leaves you with 90. Now, if you've looked at, let's say, banks against technology, you've already seen technology against banks. Similar if you've seen, you know, insurance versus, I don't know, staples, you've seen the reverse as well. So that number of 90, you can actually divide by 2. But it still means that you have 45 individual charts that you need to look at.
And remember and compare.
And remember, yeah, because you're browsing through them.
Right.
I mean, 45 doesn't sound much, but oh, number 3 looks good, number 7 looks good, number 8 looks good, oh, number 20 looks good, and then at the end you say, oh, which ones were they?
Right.
So what I try to do is bring all that information into one chart. And let's see if that is the next slide. This is the basic RRG plot as it came out.
There are those 4 quadrangles.
Yeah, so it's 4 quadrants, and there are actually 2 measures that we're looking at. The first one on the horizontal axis is the JDKRS ratio. That is a measure of trends in relative strength. So be careful, it's not just performance, it's a trend in relative strength.
JDK stands for your initials.
That's me. Yeah, this was launched in Bloomberg, on the Bloomberg terminal in 2011. And we had to come up with a name, and that's basically what Bloomberg came up with. So we stuck with that since 2011. That ratio measures trends in relative strength. Now, these, as you can imagine, these trends sometimes can extend very long. You know, so in 2000, during the tech bubble, you know, my ratio charts, my ranking system was off the charts. You know, technology was way up there.
Right.
And it started to come down, but you know, it is a trend-following algorithm, so it takes a little bit of time before it actually starts to roll over. Right. So I got an email
because I remember, I mean, the P's, which were about 15, 16 historically in IT space, moved up to 60, and then it moved up still beyond that.
Yeah.
So I can understand.
Yeah. So it was really, really high, and then when it started to roll over, and you know, my system didn't really adjust yet. Right. So I got an email from an Italian investor saying, well, this time your system didn't work too well. sort of right. And I thought, okay, I need to figure out how this works. So in the technical toolkit, we have momentum, rate of change. And as you know, that rate of change is a leading indicator.
Right.
You know, so something moves. I always compare it with someone who throws a ball up in the air. You know, you throw that ball up in the air, it's got a lot of speed. At some point, it reaches a static level before it turns down.
Right.
On the way up, it's losing speed. So it's faster, and then so it stands still, and then it turns over. And in the beginning, the speed, and then it picks up speed, and when it's back in your hand, it's got high speed again. So I started applying rate of change to that RS ratio indicator. And what happened is that when you plot it on those axes, what happens is in the top right-hand corner, in that leading quadrant, as we call it, you will find sectors or stocks that are in relative uptrends, and that uptrend is still being pushed higher by strong momentum.
Okay.
Now, the first thing that will happen is that your momentum will roll over, and that's when it's being pushed into the weakening quadrant. So there's still a relative uptrend there, but it's losing power.
Fine.
If that loss of power continues, it is pushed into the lower left-hand quadrant. And there you will find...
Which is an underperformer.
That is a lagging quadrant.
Right.
So that is relative downtrends.
Yeah.
So you will find sectors that are underperforming the benchmark, and that underperformance is still being pushed further down by downward momentum. And then just like in the leading quadrant, you will find rate of change curling up first and pushing it into the improving quadrant, which is, you know, still a relative downtrend, but picking up. And then you'll get that circular motion that we see. And when I first had this, and this is, mind you, the first version of this was an Excel spreadsheet as big as this screen. And I was probably the only person that could...
I believe it was some 16 feet by 16 feet.
Yeah, something like that. Yeah, and you know, and I was the only person that could work with it because there was a lot of VBA code, and you know, you change this cell and then it changes everywhere, and you couldn't give it to anyone.
So you're saying the complete Excel sheet, which was 16 feet by 16 feet, is all in a concise format in this...
Exactly, yeah. So that's what came out.
Okay.
And it actually, and I think the next one is, so here is a real version, and this actually is
Now tell me, I mean, here it moves in the clockwise direction always, or it can move anti-clockwise?
It always moves in a clockwise direction.
Okay.
The rotation is always clockwise. Sometimes you can see because you can do this on various time frames, weekly, daily, even intraday or monthly or whatever. It doesn't really matter. It's just like a normal chart that you can chart on any time frame. Sometimes you will see, like on a weekly time frame, I call that hooks. So when it just seems to make a hook. And the reason for that is that the rotation is done so fast that that time frame cannot pick it up.
Okay.
So when you see that on a weekly and you switch to a daily time frame, you will see that it rotates on that daily, going in the same direction.
But then there is no specific time scale you would suggest. I mean,
no, it depends on what sort of investor you are.
Where does it work best, I would say?
For me, it works best on the weekly time frame because most of the people that I work with are longer-term oriented investors, and you know they cannot. They're professionals, so they cannot trade in and out of a stock or a sector like the same week or the same day. So they need longer-term trends. But I actually have clients in the forex space who use RRGs on 5-minute intervals. Okay. You know, so plotting the rotation of various currencies throughout the day to alert them to where, you know, which currencies are picking up or losing against the US dollar or the euro or whatever their benchmark currency is.
Okay, but can this be used as a trading model?
Yes, it can. It was never designed as a trading model. Okay. It was designed as a visualization system. I wanted to make investors aware of where strength and weakness was. But since it was introduced, I think the most asked question was, you know, what is the performance? What is the track record? What are the trading rules? And, you know, I started saying, all right, what is a trading rule for a weekly bar chart? Or what is your trading rule for a candlestick? I mean, there is none. It's different for you. It's different for me. There's many different people.
Right.
So
I think it's just like the story we have in India about 6 blind men and the elephant.
Tell me, what's that?
So in that, I mean, every blind person has a different view of the elephant. One person touches the trunk, and thinks it's a snake. The other person touches the legs and it thinks it's a trunk of the tree. And someone else touches the tail and thinks it's
something else.
Yeah,
well, yeah.
Like it's a rope. So I suppose from a technical analyst point of view, it's
perfect. Yeah, perfect analogy. Yeah, absolutely. As you know, it depends on the user, what it does and how you look at it. Yeah, for sure.
Okay. Now, as a fund manager, generally I think people would be asking you as to what are the 5 top picks.
Well,
But I think you have a different view on that.
Yes, that actually, you know, when I started, I started after the military. I started working as a fund manager. That was on the buy side, and then later on in my career, I went to the sell side, where my job was to produce research on European sectors. And you know, you compete with all the banks to provide your research and your ideas. And all these guys are super busy. So I always try to prepare, you know, I've got, you know, a couple of sectors that I want to highlight and you're cool and da-da-da. And then they said, oh, no. I mean, this week is technology week. Give me your best 5 picks in technology. And I said, oh, I didn't prepare that. So I wanted to be able to answer that question. And that's how that RS ratio, that ranking system came to life. But then at one stage, I had an intern on my desk, and I asked him, I said, okay, go back to all the reports that I've written in the 4 years it was at that time, and see what the performance of those recommendations was. So he did that, calculated, said, well, that's pretty good. You're beating the benchmark, that's nice. But it was like only 4 years, so 48 reports, which is not a big sample. So the problem was that it was rules-based, but I made the final call, you know, bringing in like a chart or some other stuff. We said, okay, let's forget about the judgmental call. Let's just put the rules there that I used at the time and look back. And Dow Jones Stocks was the index family that I was using, had data going back to the 80s. So he did the same work for all those years, came back like, all right, these rules sort of give you an edge. They're outperforming the index. But then he did one thing that was super interesting, because my recommendations could only be underperform, neutral, or outperform. And he took all the outperformance recommendations and all the underperformance recommendations and calculated the excess return, so the alpha that was captured by those recommendations. And what he found is that the alpha, the excess return on the underperformance recommendations was significantly higher than the alpha that was captured on the outperformance recommendations. And from that time onwards, I'm telling all these guys on the phone, if you ask me, like, what are the best, I said, you're asking me the wrong question. You should ask me where I should not be invested. And, you know, I've done this now for several years. And I'm sure that, you know, everybody in the room, if you're a PM or of your own portfolio or whatever, at the end of the year, when you look back at your portfolio, we're all able to pinpoint like 3, 4, 5 positions of which you think, if I only could have avoided having those positions,
those mistakes,
those bleeders, then I would have made so much more return. And that's what that comes down to.
I think that should be the major takeaway from this discussion with you. I think we don't have much of time, so I'll just quickly...
Indian variable time.
Yeah.
I mean, you can do a lot here.
I think you'll get used to it. This is your first trip. From an Indian market point of view, I would like to ask you as to how mature you think the Indian market is from the global technical analyst point of view, and what caution does one need to adopt in trading this market?
Yeah, I think it was already in the panel discussion it came across. I think the Indian market, I mean, personally, 15 years ago, I had never seen a chart of the Nifty. And now it's on everybody's map. So India is internationally on the map. I don't think that India is be seen as an emerging market anymore. It's not 100% matured, but it's very much on the way. It's much more on the radar screens of a lot of banks, a lot of investors. So it's becoming much a more interesting market from an international perspective to look at. The risks, as mentioned before, I think is liquidity, because especially from a technical point of view, we're looking at collective market behavior, at the behavior of big groups of people.
Right.
So if you have liquid stocks, you look at the behavior of a lot of people. If you look at thinly traded stocks, you look at the behavior of only a handful of people. And the odds for that handful of people to change their mind is much bigger than the odds of the big group that trades, the highly liquid stock to change their mind.
Right, right.
So the risks are in the thinly traded stocks, in the small cap stocks.
Okay. And finally, I think what most of us and most of the people in the audience would like to hear from you as to applying RRG to the Indian markets.
Where are we now?
Yeah.
Yeah. Let me see. We do have that chart
We have
somewhere.
that, fine.
Okay, by the way, this is a cool chart because now you can see actually the rotational movement over time. So this is 1 year.
1 year, okay, fine.
1 year worth of data. So you can actually see that circular movement. We skip through this really fast. This is a number of international stock market indexes. I'm not sure if you. I hope you can actually.
I don't think it's very clear, but maybe you can just explain that.
India is there's a blue line that
right on the top
shoots from lagging into improving. So the highest observation on the screen, that's the Nifty index.
And
so
with a very long tail.
With a very long tail, and the length of the tail actually indicates the power behind the move, the momentum behind the move. So it's moving very powerful into the improving quadrant and heading towards the leading quadrant. So it's one of the stronger markets at the moment. And
based on this, you feel it will get stronger possibly in 2020.
Well, this is a weekly chart, so this can actually happen in the next few weeks or months.
Okay.
But this trend is underway, and it's pretty good. And to come back to the question, like underperformance, the purple one that's turning around, that's China.
Okay.
And the red one that is moving further into the lagging quadrant, that's the UK. And me being a neighbor of the UK, I think, well, very good luck with your Brexit. So that's so thank you very much. So yeah, India is well positioned in the international space at the moment.
Okay.
Yeah.
And if you come to sectors in India,
that's the next one. So here we're moving one level down. So these are the sectors, the Nifty sectors against the Nifty index. Again, the blue one over there, that's private banks. So that's positioned very well. It's curling through lagging into improving and heading towards leading. And there is another one, the yellow one in the weakening quadrant, that's the financial services index. And that's even better because it's not even made it to the lagging quadrant. It came from leading,
it's going back
through weakening and curling back up. So that's a typical behavior for very strong trends, where it moves from leading, weakening, back into leading. And again, here also the one that you, I think, at least for the time being, should avoid is IT. That's the red one that's crossing into the lagging quadrant. That's a strong relative downtrend versus the Nifty.
Sure. So I think we are run out of time. So can we have some questions? No? Okay, fine. So
no questions.
Thanks, Julius.
I mean, you can find me, just go on the website or find me on Stock Charts. I'll be happy to take any questions over email. Twitter handle, RRG Research. Happy to engage. No problem.
Okay, thanks a lot.
Thanks, Ambareesh. Thank you so much.
Yes, yeah.